There's a chart that predicted the panic of 1893, and the crash of 1929, and the crisis of 2008. A farmer from Ohio drew it in 1875 with nothing but a pencil and paper, mapping what he called the periods when to make money. No computers, no sophisticated economic models, just observation of patterns stretching back decades. Samuel Benner claimed financial markets moved in predictable cycles: buy years, sell years, panic years. The cycles repeated like clockwork, and if you knew the pattern, you could position yourself years before disaster struck. Most dismissed it as folk wisdom from a man who went bankrupt farming. But here's what makes it disturbing. The pattern worked, not perfectly, but far better than random chance. Benner's chart called major panics in 1891, 1896, and 1907 before they happened. It flagged danger zones where crashes clustered, and while his specific year-by-year predictions eventually failed, the underlying truth he observed remains. Financial crises don't arrive randomly. They follow patterns built into how markets, credit, and human psychology interact. Once you understand those patterns, history stops looking like chaos and starts looking like a script that keeps getting performed with different actors but the same ending. This isn't about a single magical number. This is about recognizing that financial systems have built-in rhythms. Credit cycles, asset price booms and busts, debt buildups that must eventually unwind. These forces create recurring crises that look different on the surface but share fundamental DNA. And in 2025, as stock markets hit records while household debt climbs and warning signs flash across multiple indicators, the question isn't if the pattern repeats. It's when, and whether you'll see it coming. The first systematic attempt to map crisis patterns came not from economists but from farmers and merchants who watched commodity prices rise and fall with disturbing regularity. Samuel Benner, an Ohio farmer who lost his fortune in the panic of 1873, became obsessed with understanding why financial disasters kept happening. Between 1873 and 1875, he studied every panic, crash, and recession he could document going back to the early 1800s. What emerged was his chart dividing time into three recurring phases. Years to buy, when assets were cheap and fear dominated markets. Years to sell, when prices peaked and euphoria reigned. And panic years, when the system collapsed under its own weight. Benner claimed these phases repeated in cycles, with panic years following a 1-6-1-8-2-0-year pattern according to his published work. Good years in relation to these panics, and hard times for specific commodities, following different but equally predictable rhythms. He based his analysis on historical commodity prices, particularly pig iron, hogs, corn, and cotton. The chart worked surprisingly well for decades. It correctly identified the approximate timing of the panic of 1891. It flagged 1896 and 1907 as danger years, and both saw major financial disruptions. By the time of Benner's death in 1896, financial professionals were reportedly consulting his chart despite its folksy origins. Later, another forecaster named George Tritch is believed to have extended Benner's cycle projections all the way to 2059, but eventually the specific year predictions became less reliable. The pattern wasn't as mechanical as Benner hoped. Markets evolved. New technologies, regulations, and institutions changed how crises manifested. By the mid-20th century, his chart had been largely forgotten as a curiosity of financial history. Yet Benner had observed something real that modern research confirms. Financial crises do cluster in time. They follow patterns driven by forces deeper than any single event or policy. Modern economic research, armed with data Benner never had access to, has validated the core insight while refining the mechanism. According to business cycle data from the National Bureau of Economic Research tracking cycles back to 1854, the frequency and duration of financial crises has evolved dramatically but follows identifiable patterns. From 1854 to 1919, there were 16 complete boom-bust cycles, according to NBER documentation. Recessions lasted an average of 22 months. Expansions lasted just 27 months on average. The system spent nearly as much time contracting as growing. Financial panics were common, often coinciding with bank failures that wiped out savings and credit. From 1919 to 1945, crisis frequency changed. 6 cycles occurred, with recessions averaging 18 months and expansions lasting 35 months, according to NBER data. The system became slightly more stable, though this period included the catastrophic Great Depression, which lasted over 3 years and destroyed approximately a quarter of economic activity. From 1945 to 2001, 10 cycles occurred. Recessions shortened dramatically to an average of just 10 months, while expansions extended to 57 months. The post-war era appeared to have tamed the business cycle through better monetary policy, deposit insurance, and fiscal stabilizers. But this apparent stability masked deeper rhythms. While short-term recessions became less severe and less frequent, major financial crises, the kind that threatened the entire system, continued occurring with striking regularity. The Great Depression in the 1,930 seconds, the Latin American debt crisis and savings and loan collapse in the 1,980 seconds, the Asian financial crisis in 1997, the dot-com bubble burst in 2000, the global financial crisis in 2008. These aren't random occurrences. Research suggests they result from longer cycles in credit, debt, and asset prices that take decades to build and years to unwind. Research analyzing 17 advanced economies over 130 years from the 1,880 seconds through 2013 reveals that financial crises in developed nations occur approximately once every 25 years on average, according to multiple economic studies. This isn't a precise clock. Some countries go 40 or 50 years between crises. Others experience multiple crises within a decade. But the average holds remarkably consistent across different eras and different nations. A generation builds wealth, takes on debt, bids up assets, and eventually creates the conditions for collapse. The next generation cleans up the mess, rebuilds, and repeats the pattern. The mechanism driving these cycles is now well understood. Financial crises follow a predictable sequence that plays out over years or decades. First comes credit expansion. Banks lend aggressively. Borrowers take on debt to buy assets. Asset prices rise, which makes the collateral backing loans more valuable, which encourages even more lending. This creates a self-reinforcing boom where credit, asset prices, and economic activity all rise together. Second comes the euphoria phase. Asset prices disconnect from fundamental values. People buy not because assets generate income, but because prices are rising and everyone expects them to keep rising. Stories emerge explaining why this time is different, why the boom can continue indefinitely. Real estate only goes up. Technology has created a new paradigm. Emerging markets offer unlimited growth. The specific narrative changes, but the psychology remains constant. Third comes the peak. Credit growth slows, either because regulators tighten lending standards, because interest rates rise, or simply because there are no more qualified borrowers left. Asset prices level off or begin declining. Suddenly, the logic supporting sky-high valuations evaporates. Assets bought only because prices were rising become unsellable when prices stop rising. Fourth comes the crisis. Borrowers who took on debt they couldn't afford begin defaulting. Banks holding those loans face losses. Asset prices collapse as forced selling creates downward spirals. Credit markets freeze as banks stop lending to each other, unsure who's solvent. The boom unwinds violently, destroying wealth and triggering recession. Finally comes the recovery and reconstruction phase, which can take years or decades. Debts get restructured or written off. Asset prices find new lows. Eventually, conditions stabilize and the economy begins growing again. But the memory of the crisis fades, new generations enter markets, and slowly, inevitably, the cycle begins again. This pattern has played out repeatedly across centuries and continents. The Dutch tulip mania of 1637, the South Sea bubble in England in 1720, the Panic of 1,819 inches, America, the Panic of 1,837, the Panic of 1,857, the Panic of 1,873, the Panic of 1,893, the Panic of 1,907, the Great Depression beginning in 1929, the Latin American debt crisis of the 1,980 seconds, the Japanese asset bubble collapse in 1990, the Asian financial crisis of 1,997, the dot-com bubble of 2000, the global financial crisis of 2008. Different assets, different technologies, different institutional structures, but the same fundamental sequence. What makes this pattern so persistent? Why don't we learn? The answer lies in how credit and human psychology interact. Credit is fundamentally about trading present consumption for future obligation. When you borrow, you get to spend now and promise to repay later. This time shifting of resources is enormously powerful for economic growth. It allows businesses to invest before they've accumulated savings, homeowners to buy before they've saved the full purchase price, students to pay for education before they earn income. But credit also creates moral hazard and information problems that guarantee cyclical instability. Lenders profit from making loans but don't bear the full risk if borrowers default, especially when they can sell loans to others. This encourages excessive lending. Borrowers underestimate the risk they're taking on, especially during booms when asset prices are rising and everyone around them is borrowing successfully. Both lenders and borrowers extrapolate recent conditions into the future, assuming good times will continue, which creates exactly the leverage and speculation that makes crises inevitable. Moreover, financial systems are inherently procyclical. When times are good, banks lend more, which fuels further growth, which makes times even better. When times are bad, banks lend less, which deepens the contraction, which makes times worse. Regulations requiring banks to hold capital proportional to risk make this worse. During booms, risks appear low, so banks need less capital and can lend more. During busts, risks spike, forcing banks to hold more capital and lend less. The system amplifies both upswings and downswings rather than stabilizing them. Research has identified specific early warning indicators that flash before crises. Rapid credit growth, particularly when credit expands much faster than GDP, is one of the strongest predictors. When the credit to GDP ratio rises rapidly, a crisis typically follows within 3 to 5 years. This happened before the Great Depression, before the Asian financial crisis, before 2008, and before virtually every major banking crisis in modern history. Asset price booms, particularly in real estate and equities, are another reliable indicator. When house prices or stock prices rise far faster than incomes or corporate earnings can justify, a correction becomes likely. The challenge is that during booms, everyone can point to reasons why valuations are justified. New technologies, demographic shifts, globalization, easy money. The reasons vary, but the outcome remains consistent. Prices disconnected from fundamentals eventually reconnect violently. Rising inequality, specifically rapid increases in top income shares, also predicts crises with disturbing accuracy. Research analyzing advanced economies from 1870 to 2013 found that when the top 1%'s income share rises rapidly in the years before a crisis, the subsequent downturn is typically more severe and the recovery slower. The mechanism appears to run through both debt and demand. Rising inequality often leads middle and lower income households to borrow more to maintain consumption, creating household debt vulnerabilities. It also creates political pressure for looser credit conditions, and it concentrates wealth with those most likely to speculate in asset markets, amplifying booms and busts. Prolonged, low productivity growth is another warning sign. When productivity stagnates for years, it suggests the economy has exhausted easy growth opportunities and is increasingly relying on leverage rather than real value creation to sustain expansion. This creates fragility. Debts taken on during stagnant productivity periods become difficult to service when growth slows, triggering defaults and crisis. So where are we in the cycle today? Multiple indicators suggest we're in late stages of expansion, heading toward conditions that historically precede crises. Credit has expanded dramatically. Total U.S. household debt exceeded $17 trillion as of 2024, with mortgage debt accounting for nearly $12 trillion, auto loans approximately $1.6 trillion, and credit card debt approaching $1.1 trillion according to Federal Reserve data. Corporate debt has reached record levels relative to GDP. Governments worldwide, particularly advanced economies, carry debt burdens that would have been considered unsustainable in previous eras. Asset prices in multiple categories appear elevated relative to historical norms. Stock market valuations measured by various metrics, including price-to-earnings ratios, price-to-sales ratios, and market capitalization to GDP, sit at levels that have historically preceded corrections. Real estate prices in many major metropolitan areas have surged to levels that exceed affordability for median income buyers by historic margins. Cryptocurrencies and other speculative assets have experienced boom-bust cycles reminiscent of earlier manias. Income inequality has risen sharply over recent decades. The top 1%'s share of income has increased dramatically since the 1980s, approaching levels last seen in the 1,920 seconds before the Great Depression. Productivity growth has slowed substantially from post-war averages. The easy gains from computerization and globalization appear largely captured, while newer technologies haven't yet generated comparable productivity accelerations. These conditions don't guarantee imminent crisis. Timing is notoriously difficult. Markets can remain overvalued for years before correcting. Credit can continue expanding longer than seems sustainable. But the ingredients are present. We're carrying record debt loads while asset prices sit at stretched valuations. Inequality has risen to levels that historically precede instability, and productivity gains have slowed. The pattern suggests vulnerability. What would trigger the next crisis? History offers little precise guidance on triggers, which are often minor events that expose underlying fragility. A modest interest rate increase, a geopolitical shock, a bankruptcy that reveals hidden interconnections, a policy mistake, a pandemic that disrupts supply chains and forces lockdowns. Oh wait, we had that one, and the system survived through unprecedented monetary and fiscal intervention. But that intervention created its own consequences. Government debt exploded. Central banks expanded balance sheets by trillions. Money supply growth accelerated dramatically, contributing to inflation surges in 2021 and 2022. The question for 2025 and beyond is whether we've simply delayed the reckoning or actually escaped it. The pattern suggests delay is more likely than escape. Financial crises result from excessive debt and elevated asset prices, eventually forcing painful adjustments. Those adjustments can be spread gradually over years through slow deleveraging and moderate deflation. Or they can happen suddenly through crisis and collapse. Policy can influence timing and severity, but rarely eliminates the need for adjustment entirely. The lesson from studying crisis patterns isn't that you can time markets perfectly or predict exact dates years in advance. Samuel Benner's chart eventually failed because markets aren't clockwork mechanisms. But the lesson is that certain conditions reliably precede crises: rapid credit growth, asset price disconnection from fundamentals, rising inequality, productivity stagnation. When these align, the probability of crisis rises dramatically, even if the exact timing remains uncertain. For individuals, understanding this pattern means recognizing that what feels like normal during late-stage booms, rising home prices, easy credit, soaring stock markets, is actually the dangerous phase. The time to prepare isn't when crisis hits, it's when everything seems fine, when everyone around you is taking on leverage, when caution feels unnecessary. That's when the pattern says, danger is building, history doesn't. Repeat with mathematical precision. But it rhymes with disturbing regularity. And in 2025, standing in an economy with record debt, elevated asset valuations, high inequality, and slowing productivity, the rhythm feels familiar. Not because we can predict the year or month of the next crisis, but because the conditions that precede crises are once again in place. The pattern isn't hidden. It's written across centuries of financial history. The question is whether this generation will see it before it's too late, or learn the lesson the hard way, the way every previous generation has. If this gave you a new perspective on financial cycles and what patterns actually matter, hit that subscribe button. The crises change their clothes, but they never change their character. Understanding the pattern is the first step to protecting yourself when it repeats. History has the answers, if you're willing to look past the surface.